Welcome to BARR Financial Services video market commentary for the first quarter of 2010. In an effort to improve these commentaries to make them more beneficial and insightful, we've adopted a new format that includes graphs and better resolution. Please let us know what you think of the new format. Equity and fixed income markets were heightened in the first quarter of 2010 by largely positive economic data that suggests the recovery in most parts of the world is well underway. Most major equity indexes were positive for the quarter, with the S&P 500 gaining 5.4%. As indicated by the graph, the S&P climbed from its low on March 9th last year and ended the quarter up over 76%. But it still remains almost 21% below the peak reached October of 2007. That is a remarkable recovery in a short period of time, and it is not far off from its all-time high. Outside the U.S., gains were more modest. For all of its issues, the U.S. economy is starting to look good compared to Europe. Production continues to expand, helped by inventory rebuilding and rising exports. Employment should start to grow again, providing a boost to consumption and creating a virtuous cycle that has been missing thus far in the recovery. The bond market also produced positive returns for the quarter. Surging profits are prompting economists to revise their estimates for growth, tilting the recovery in more of a direction of a V-shaped traditional recovery. Companies have a lot more capital, and they're going to deploy it in equipment and hiring rather than sitting on it. It is quite possible the economy produces a recovery significantly stronger than people anticipate. The expansion will feed back into corporate earnings and pave way for a further rally in the stock market. This is the opinion of the chief U.S. economist at Deutsche Bank. The odds that the U.S. will relapse into a recession has fallen to 15% from 25% at the start of this year, thanks in part to rising profits. In my opinion, we're not going to have a double dip. It is more a question of whether we're going to come out of this with moderate growth or surprisingly rapid growth. The Business Roundtable's CEO Economic Outlook Survey showed 47% of executives plan to spend more during the next 6 months, and 29% plan to increase hiring during the next 6 months. The Conference Board's leading economic index has risen steadily for a year now, led by improvements in financial and the labor market indicators. Payroll employment made its first substantial contribution to the index, suggesting that the recovery is beginning to gain traction. This index is an indicator of economic activity expected over the next 3 to 6 months. As you can tell from the graph, it has been on an inverted path since March of last year. My general view on equities remains positive, although the appreciation potential is less dynamic now that the markets are well out of the recovery stage. Many economists believe that the U.S. stocks are undervalued. As indicated by the graph of the S&P 500 at inflection points, we observed from the recession earlier in this decade was down 49%, followed by an increase of over 100%. The recent recession shows a fall of 57%, with a rally through March up 73%. There would seem to be more room for growth. A review of the S&P's forward PE ratio shows a reading of 14 times, well below the average of 16.7 times since 1992. Other positive indicators include the consumer confidence grew to 52.5% with an expectation of 50. The Institute for Supply Management Manufacturing Index rose to 59.6 in March. A number above 50 indicates growth. The VIX index, dubbed Wall Street's Fear Index, which gauges investors' expectations for near-term volatility in the stock market, fell to 15.6% its lowest level since mid-2007. There are several areas of concern. First, economists generally agree that you cannot have a truly sustained recovery without improvement in housing, which has been sputtering. The Federal Reserve Chairman Ben Bernanke called housing a critical challenge to the economy, and we have yet to see evidence of a sustained recovery in housing market. Economists say evidence of a rebound may start to appear in the March data, which it did. One factor that depressed sales was the weather. Many feel housing will start showing positive signs starting in the spring. The second area of concern is the unemployment rate, currently at 9.7%, well above its 50-year average of 5.9%. Ben Bernanke is quoted as stating, "Unemployment remains an obstacle for the economy." A survey conducted by Bloomberg News of economists expected unemployment to drop to 9.4% in the fourth quarter of this year. Employers added 190,000 jobs in March, and this is only the second increase since the recession started. It will take some time to improve the unemployment situation in the housing sector. Finally, the timing and speed of global government's exit strategy for emergency fiscal and monetary policies are now a central focus. The ability to make the transition away from massive government support of the private sector while maintaining forward economic momentum will be challenging. While the stock market performance over the last year has been encouraging, the outlook warrants caution in light of the economic and fiscal challenges that lie ahead. I feel we are in a new world of investing, and changes are required. Over the last year, I have worked hard to create new programs to benefit us moving forward. This is very exciting, and I look forward to sharing these changes with you. Please let us know how we can better serve you and your needs. Thank you for your ongoing support and confidence, and thank you for listening.